Are you a US tax resident without knowing? Most people think if they don't live in the United States, they don't need to file US tax returns. In some cases, that could be wrong. You could be a US tax resident without knowing, and if you are, it can cost you thousands. There are two types of resident for US tax purposes. One is what we call a US resident. An example of a US resident are US citizens. It doesn't matter where they are residing, and also green card holders. Again, it does not matter where they are residing. They are considered US resident for US tax purposes. Another one is what we call a taxpayer that satisfied the substantial presence test. I will explain what is that test later on. Now, if you are not a US citizen, you are not a green card holder, and you don't satisfy the substantial presence test, you are considered non-resident for US tax purposes. There is a big difference on these two types of taxpayers. Those considered US residents are taxed on their worldwide income, while a non-resident is only taxed on US source income. So that's a huge difference. I will now explain what is the substantial presence test. There is a 31-day rule for the current year that you need to satisfy for you to assess if you meet the substantial presence test to be considered a US resident for that tax year. Okay. So it has to be at least 31 days during the current year, and you also need to count the number of days that you were in the United States for the last 2 years. So I will give an example. So a taxpayer has been in the United States for 31 days during 2025. So now that taxpayer needs to look back during 2024 and 2023 on how many days that he has been in the United States for us to calculate if he will satisfy the substantial presence test. So if in 2025, during 2025, he's in the United States for 31 days, that is counted for the 2025. Now, for example, in 2024, the taxpayer was in the United States for 330 days in total. We will need to divide the 330 days by a third. That is what's going to be counted as part of the substantial presence test for the 2024 tax year. So 330 divided by 3 equals 110 days. So far we've got 2025 31 days and 2024 110 days because we divided the 330 days divided by 3. So we have so far 141 days. Now we need to look on the 2023 year. For example, if the same taxpayer was also in the United States for 300 days during 2023, 2023, we need to divide the 300 days by 6. So 300 days divided by 6 equals 50 days. So we now add the 3 years. The 2025, he's been there for 31 days. That's all counted. For 2024, he was in the United States for 330 days. We took a third of that, which is 110 days. And then we add the 2023 days, which is 300 days divided by 6, which is equivalent to 50 days. So 31 days plus 110 days plus the 50 days equals 191 days. So he satisfied the substantial presence test because he was in the United States for the last 3 years for more than 183 days. So that is mostly where an individual can get it wrong. This is a mathematical formula that needed to be looked at if you are not in the US for the full year. Okay? So, yeah, there is a common mistakes that if the person was only in the US for a few months, there's a probability that that individual would think, oh, I don't have any filing obligation. Or that individual could only be traveling back and forth, back and forth. Well, you're traveling back and forth, the number of days could exceed the 183 days. Or the individual could also be thinking, oh, I've got my visa. I don't have any filing obligation. Well, traveling visa and filing obligations are two different things. So what are the type of individuals that could be making these common mistakes? Well, an example of that could be an Australian consultant flying to the US regularly. Or that individual could be a business owner, a digital nomad. Or that individual could be a student. So there are a lot of taxpayers or individuals that go to the United States and stay there for a while without knowing that there could be some tax consequences. So what happens if you get it wrong? Then obviously you will possibly be filing the wrong tax return or not filing a tax return at all. Or if there are withholdings, if you earned income while you were in the United States, you could be overpaying tax because of a wrong withholding. Because generally, if you are a non-resident, the payer will withhold 30% tax on income before they're going to pay you the rest. And if you are not aware that you could be filing a tax return, then you will be possibly having to be exposed to the Internal Revenue Service. So if you are unsure about your residency status, this is exactly what I help clients with. I have been doing US expats cross-border taxation between US and Australia for the last 15 years. If you need clarity on your situation, book a clarity call, email us at hello@usautax.com, and I will assist you in your questions. Disclaimer, please note, this video is intended for information purposes only and does not constitute any tax or legal advice. These insights are designed to serve as a starting point to help identify areas that may require further professional understanding. Please consult with a qualified cross-border tax professional regarding your specific circumstances. See you in the next one.